Hi, I'm James Robinson, and this is my stock pick of the week. So the company's operations, to me, to my way of thinking, is looking at how good a job and how efficient a job a company does in producing and delivering its goods and services to the customer. I think there's a number of components that make that up, and so we're going to look at each of those components individually and discuss where this company ranks and why that is or isn't important. The first section I always look at is gross margins. The reason I look at gross margins is the higher your margins are, in my opinion, the larger your ability to make mistakes. If you've got an 80% gross margin and you have a 5% reduction in gross margin, you still have massive margins. If you have a 5% gross margin, you have a 5% reduction in gross margins, you're losing money. So I think that gross margin, I look at that as altitude and opportunities for mistakes. I also look at gross margins as pricing power. The higher your gross margins, the more likely you are to have pricing power. And that pricing power is likely to survive through things like recessions because it means there's demand. It's also likely to survive high inflation because you have pricing power and can raise your prices. So having said that, I always start with gross margins, and I think the gross margins are very, very important, but no single item is so important as to make everything else irrelevant. And so this company is probably the lowest gross margin of any company you'll ever see me recommend. It's just barely above the top 10% of companies in gross margins. So why am I suggesting you should buy it? Well, because I don't think in this case the gross margins matter. It's an industry that has relatively low gross margins. The company has 81 years straight with a profit, including through the recessions of 2006 and 2007 and 2008. So these guys have figured it out. They've figured out how to run their operation in good times and bads with these narrow margins. Also, they make a premium product and a product which is in demand in the industry. So while gross margin, you look at this and go, why would you ever recommend this? I think you have to hear the rest of the story. So here you can see the company's earnings and earnings per share. The important thing to look at is, generally speaking, the earnings have had upward swings. There have been kind of 2 or 3 years surrounding the Great Recession where earnings were down, but they weren't zero. And then 2015 was kind of a weird year. It's not worth getting into why, because the company's fully recovered, and that was 5 years ago now. But long story short, if you look at it from 2007 until today, you can see that earnings have gone up pretty consistently most years. When you look at earnings per share, you'll see that the earnings per share have gone up more dramatically than earnings. That's because the company has been buying back shares. Obviously, that's a really good sign. So when you look at earnings per share, you say, okay, even though this company has very, very poor gross margins, those gross margins haven't hurt the company as much as companies with much larger margins were hurt in the recession, for example. And especially for a heavy manufacturer like this company, that's really surprising, and it's a sign that it's in a unique position in an industry. So when we look at net earnings as a percentage of revenue, it's really interesting that a company amongst the bottom 10% of gross margins is able to create this much earnings as a percentage of revenue, because such a huge percentage of the revenue is going to cost of goods sold. It shouldn't leave any room for high earnings relative to revenues. What that means is that in everything that's not cost of goods sold and cost of manufacturing, this company operates exceptionally well and efficiently. So that's a really good thing. The other thing to keep in mind is that since 2007, this number has been going up. Its net earnings relative to revenue has been increasing. It's been going up again since 2015, and it's relatively flat. So we're not seeing huge gyrations, but we are seeing gradual improvement. That's a fantastic sign, especially with a company with low margins, because every penny we can save here really does end up straight to the bottom line. Net earnings as a percentage of revenues, what we're looking at here is, are the margins eroding? And I don't think that they are. I think that they're staying pretty stable. So we're okay with issues related to revenues and earnings. The next category that we look at is selling and general administrative. You can see that this company is extremely efficient in this category, just outside of the top 10%. And again, since 2015, that number has improved every year, and it's improved dramatically since 2009 when the recession happened. So we see that this company's selling and general administrative is very, very low. We're going to talk this slide and the next slide about what I call the 4 taxes. They're operating taxes. After we paid the cost of goods sold, we have these operating costs that every company has to pay, and that's really where management is able to do a great job, if they're good management, of winnowing those costs down and creating money for the customers, creating money for the ownership. And in selling and general administrative, they've done that. When you look at plants and equipment, this company is obviously, because it's a manufacturer, it's going to have significant plants and equipment costs. And this company's no exception. But if you look at it again, since 2015, that number has come down every year and come down rather dramatically. So that's a really good sign that you've got this significant cost center and that number is coming down every year. Inventory and R&D. So first we're talking about inventories. That number has been basically flat since 2019. This is inventory as a percentage of revenues. So again, as you see revenues increase, you would see inventories increase. You'd expect that. This is when we look at those two related to each other. So again, I see this number as being a constant. It's 30% of companies have no inventory at all. So it's not going to ever be in that category as a manufacturer, but it's in a very good category, clearly in the top 25, probably close to the top 15% of companies that we look at. And for a heavy manufacturer, that is an indication that this company is exceptionally well managed. Looking at R&D, you can see this company is spending money in R&D, and it's spending a lot. It's in the bottom 25% of companies. Now, keep in mind that most companies don't do any R&D. And so if you do any R&D, you fall behind here. And R&D is not always a good thing, but this company is doing some interesting things with R&D. They've got a new engine and power plant and new trucks that are being developed all the time. That's sort of the minutia of operations. It's not really worth talking about. But what they're also doing is they're working really hard on electrical trucks. Tesla, as you know, is making an electric truck. I've done a video on Tesla, and I talked about their semi-truck as a potential significant profit center. These guys are making a truck, and they really know the industry, and they know their customers. So we'll talk more about the truck in a few minutes. So by way of a little bit of summary, gross margins are very, very low for a company that I would recommend. If everything else in this company was good, not great, but good, I probably wouldn't buy or suggest you buy this company based on its relatively low gross margins. However, much of the low margins are recovered in the handling of what we call the four taxes. The selling, general, administrative, plants and equipment, inventory management, and R&D are all very well managed. They're very relatively low, especially relative to their industry, and they seem to be either flat or, in a couple of cases, shrinking. The company is investing money in R&D, but it's doing so in a way which I applaud, which I think will continue to make the company succeed in the future. So again, each of the four taxes are either down or steady for the last 5 and 10 years. The company has had 81 years without a loss. That's a very significant thing. That means it's gone through many, many recessions. Even though it has these low margins, it's figured out how to run its business with those low margins. The selling, general, administrative is low and shrinking. Plants and equipment are well managed and shrinking. Inventory is flat for almost 20 years. By other ways of summarizing, Paccar is gigantic. It's a $24 billion company. It's the 7th largest truck manufacturer in the world. In North America, they have a 28% market share. That's pretty significant. The share in Europe is 8%. There are 1.9 million long-haul truckers in America. And what I want you to understand here is, so the average age of those truckers is 55 years old. It's a very significant problem in the industry that they have to be recruiting new drivers. Well, Paccar makes a very high-quality truck that's more luxurious and easier to drive and cheaper to drive than their competitors. But those trucks are 10 to 15% more expensive. One of the things that they're finding, which is really interesting, is that companies are using the fact that they have great trucks to recruit young drivers. If you're going to come, and they also have to have newer trucks to recruit young drivers. And so the fact that there's a shortage of drivers, now means that the premium brands have a higher value. And by the way, that also is carrying on with smaller one-off drivers. They basically live in their truck. And so they have a choice. Would you rather live in a Volkswagen or a Mercedes? If the cost difference is 10%, and the cost difference relative to fuel and insurance and all of the other costs to run a trucking company are taken into effect, it's really an insignificant cost difference. So that's one of the reasons why Paccar is doing so well and why I think it's going to do well in the future. The manufacturing arm of this company has no debt. The company has $6 billion in debt, long-term debt, but that's being used by the finance arm, and the finance arm is about $14 billion. We're going to talk more about debt later, but the manufacturer is about $14 billion of assets. The manufacturing arm of this company has no debt. If they wanted to, they could jettison or spin off the finance arm, and they would have a debt-free company. I believe trucking is a growing industry, but I also believe there's not much differentiation between one trucker and another. Literally, it's like one airline. What do you care whether you're flying United or American Airlines? Other than the frequent flyer miles, there's no differentiation between those two airlines. It's just whichever one is cheapest and most efficient for your travel, and that's really the way it is in trucking. But all these truckers that are out there, it doesn't matter who they are, it doesn't matter how they do individually, there's a certain number of miles that have to be driven by trucks every year, and trucks are good for 1 million miles each. So sooner or later, you have to buy new trucks. And as the market expands, you have to buy new trucks. So these guys are a hedge against an individual trucking company doing poorly or doing well, because they all need to buy a truck. And then another interesting thing is Paccar is developing their 520 EV. They actually had a booth at the CES Auto Show. And the 520 EV is interesting because it's a garbage truck. And I just think that's brilliant. I mean, imagine, first of all, it can do its route on a single charge, because garbage trucks don't go very far and they don't go very fast. They just have to go and pick stuff up. And the beauty of an electric truck is it's all silent. I mean, every morning, twice a week on Mondays and Thursdays, the garbage truck comes down my street. It picks up recyclable loads on one day and it picks up garbage on the next. And every day I hear it and it wakes me up. An electric garbage truck sounds brilliant. And it's even more brilliant because I live in Phoenix, and in Phoenix we have the Phoenix Open, which is run by Waste Management, the largest garbage company in the world. And their whole spiel throughout the whole golf event is, improving the environment, and not damaging the environment. And so if they could buy electric trucks from a known manufacturer, it makes all the sense in the world. And that's an example of the R&D this company's doing, which I think is brilliant. So anyways, that's it for the summary and for Paccar operations. Please, if you liked the video, remember to subscribe and or like, and or I'd love to hear your comments. Thank you very much.